Hi everyone, are you ready to dive into the world of the global economy? Today we're embarking on an exciting journey to understand the global economy in one go. Sounds challenging, right? But don't worry, we'll break it down together. Have you ever seen headlines like the United States hits the debt ceiling again, or Japan's stock market hits a new high, or maybe this company is moving its factory to India? You might have wondered, what's really going on in these economies? Well, let's explore that together. Today, we'll take a professional approach, looking at things from a macroeconomic perspective. By the end, you'll have a clearer picture of the global economy. Ready? Let's get started. Let's start by getting a general overview of the global economy so we have a big picture understanding. Then we'll dive into some of the major economies to see what's going well, what's not, and where the risks are. Now, I'm not an economist, so I'm not going to make any bold claims here. I've just absorbed a lot of professional reports and insights from industry experts, and I'm sharing what I think makes sense. This video isn't just about looking at data and the current situation. I think it's also helpful to see how professionals analyze a country's macroeconomy, what angles they consider and how they think. At the end, I'll also share my personal approach to analyzing a country's economy, including my methodology and some potential pitfalls. I hope you find this information valuable, and if you're interested, feel free to save it for future reference. As we know, the global economy in 2022 was all about crisis inflation, interest rate hikes, energy crises, and so on. But in 2023, I'd say the global economic theme has been recovery. Inflation and the energy crisis have been largely brought under control, and interest rate hikes have mostly peaked. While every country has its own set of challenges, the overall economic situation is better than expected, especially in the United States and India, whose economies have outperformed expectations. It's like in 2022, the global economy was really sick, weak, struggling to fight off illness. But by 2023, it's recovering better than expected. The headache's gone, the appetite's back, and we're even able to take a few steps. Looking ahead to 2024, the focus will be on normalization, whether the global economy can return to normal without leaving any lasting damage, whether consumer spending and investment can recover, and whether inflation can be controlled as interest rates start to gradually come down. Many countries are hoping for a soft landing, avoiding a recession. I've put together the growth rates for some of the world's major economies in 2023. The fastest growing economy is India, with 7.3%, followed by China with 5.2%. At the bottom of the list are Saudi Arabia and Germany. Saudi Arabia's situation is easy to understand given its reliance on oil, and honestly, they had a fantastic 2022. But Germany struggling so much in 2023 might come as a surprise to many. Why is Germany so weak? Why are the United States and India so strong? What's going on with Japan? Don't worry, we'll get to all that step by step. Let's start with Japan. In 2023, Japan's GDP grew by 1.9%. For a country that's been stuck in economic stagnation for so long, that's not bad. But recent quarters have shown negative growth, putting Japan in a technical recession. Inflation, which Japan has battled for 30 years, is now around 3%, and unemployment remains low, consistent with Japan's tradition of near full employment. The stock market is unusually strong, but the exchange rate is weak. The central bank is considering ending its unconventional monetary policies that have been in place for over a decade. If I had to sum up Japan's economy in one word, it would be conflicted. After years of trying to achieve inflation, now that they've got it, they don't seem to like it. The exchange rate is plummeting, which Japan's economy both loves and hates. Food prices are rising, but wages aren't. The real economy is weak, but the stock market keeps going up. It's all very conflicted. Japan is probably the most complicated and chaotic economy among the major economies. Let's start with inflation. For the past 30 years, Japan's inflation rate has hovered around zero, and the country has been battling deflation. Japan's inflation target has always been 2%, but they've never been able to reach it. The Bank of Japan, or BOJ, can be said to be the most desperate central bank in the world, having tried every loose monetary policy. I bet if there were a global award for central bank innovation over the past 20 years, it would go to the BOJ. though this is more of a sarcastic remark than praise. The BOJ first introduced quantitative easing, or QE, in the early 2000s, which was an extremely aggressive monetary policy at the time. Now it's almost standard practice, but even that wasn't enough, so they came up with two more unusual policies: negative interest rates and yield curve control, or YCC. These terms may sound complicated, but their underlying logic is quite simple. Negative interest rates are aimed at lowering short-term interest rates to encourage banks and financial institutions to lend at almost zero cost. YCC, on the other hand, is about keeping long-term interest rates low, which affects things like mortgages and corporate financing, essentially making borrowing costs nearly zero for everyone in the economy, to increase the speed of money circulation and stimulate the economy. If you compare the yield curves of different countries, you might find it amusing. While the yield curves of Western central banks look like roller coasters, Japan's curve has been flat for a long time. Some people even joke that Japan's yield curve has gone completely flat. So what's happened in recent years? The US raised interest rates, so the dollar strengthened, leading to a weaker yen. In 2022, amid global inflation and energy crises, prices of goods priced in dollars soared, and with the yen weakening, imported goods, especially energy and oil, became even more expensive for Japan. This led to inflation in Japan, something they hadn't experienced in 30 years. But is this inflation a good thing for Japan? Obviously not. Japan's inflation is what's called imported inflation. It's not driven by rising demand, but rather by the sudden realization that everything is getting more expensive and unaffordable, forcing domestic prices to follow suit. This doesn't sound like a good thing, right? The items that saw the biggest price increases were food and goods, with food inflation exceeding 8%. Meanwhile, wages have barely increased, meaning that in terms of purchasing power, wages might have even decreased. When prices rise but wages don't, people stop spending, leading to a drop in consumption. Japan's consumption hasn't returned to pre-pandemic levels, which contrasts sharply with the US, where consumption has been a major economic driver. If consumption picks up, other issues might be manageable, but if consumption remains sluggish, that's a big problem. In fact, aside from the US, one of the biggest challenges many countries have faced during this global inflation is sluggish consumption. However, while imported inflation seems entirely harmful, Japan has found that it might not be all bad. Although consumption and the economy are struggling, at least it has made the Japanese realize that inflation is real, a concept that had been hard to grasp in the past 30 years. For so long, people believed that prices wouldn't change much over time and wages wouldn't rise, so it didn't matter whether you kept your money in the bank or under your mattress. Interest rates were zero anyway. But over the past 2 years, people have started to realize that prices can indeed rise. And if you don't buy something today, it might be more expensive next year, so you might as well spend now. This has started to slowly drive demand. So what should the BOJ do now? They're facing a tough decision. If they don't raise interest rates, the gap between yen and dollar interest rates will remain large, making it easy for the yen to continue depreciating. In the past 2 years, large amounts of private capital have already flowed out of Japan. If this continues, it will have a significant negative impact on the economy. And if inflation suddenly spikes and gets out of control, Japan could go from deflation to high inflation. At that point, if the BOJ has to raise rates urgently, it might crush the fragile economic recovery. That's the problem with not raising rates, but if they do raise rates, it would immediately suppress the economy, right? Japan's consumption has been the weakest link in recent quarters, and raising rates would put even more pressure on domestic demand. Moreover, Japan's government debt is the highest in the world relative to GDP. So even a slight increase in interest rates would significantly raise the cost of servicing that debt. The Japanese government has an incentive to avoid rate hikes. The most crucial question is whether Japan can exit its extreme monetary policies smoothly, returning to an environment with normal interest rates, without the BOJ endlessly buying bonds and the government borrowing like there's no tomorrow. No one knows how the economy will react to such a transition. It's like an animal that's been in a zoo for a long time. Can it survive if released back into the wild? It's hard to say. So the BOJ has been extremely cautious, moving step by step, testing the waters with small adjustments. For example, in 2022, they gradually raised the cap on 10-year government bond yields from 0.25% to 0.5%. They observed the market's reaction, which led to some speculative attacks on the yen and Japanese bonds, forcing the BOJ to intervene by buying bonds and yen. Once the market stabilized, the BOJ cautiously raised the cap to 1%. The market remained relatively calm after a brief fluctuation, and now the BOJ has hinted that it might not strictly adhere to the 1% cap, but will assess the situation. This cautious approach is like Tom Cruise's character in Mission Impossible carefully navigating a room full of traps, where any wrong move could trigger a market backlash. Looking ahead to 2024, it's going to be a crucial year. Major investment banks like JP Morgan and Goldman Sachs are predicting that the BOJ will exit its negative interest rate and YCC policies in 2024. The key question is, what will trigger the BOJ to start raising rates? What will they be watching for? From a macroeconomic perspective, the BOJ is closely watching two things. One is whether consumption can pick up, and the other, perhaps even more critical, is whether wages can rise fast enough to keep up with inflation. Price increases usually happen in stages. First, energy prices rise, then food and industrial goods, and finally services. The last thing to rise, which determines whether the economy can complete the inflation cycle, is wages. Employers typically don't raise wages unless they absolutely have to. This isn't necessarily because they're evil or exploitative. It's just that labor market adjustments take time, especially in Japan, where people tend not to change jobs often. While wages in Japan have started to rise recently, they're still far behind inflation, meaning real wages have been declining since 2020. The Japanese government is trying hard to get companies to raise wages, for example, by increasing the minimum wage and offering tax incentives to companies that raise wages. The more they raise, the more tax breaks they get. It's clear that wages are now the central focus of the market. In Japan, there's an interesting tradition called shunto, where unions negotiate with employers every year to determine wage increases. This usually happens from the beginning of the year until March, and the results influence wages across many small companies. In 2023, wages increased by 3.6%, the highest in 30 years. It's said that the target for this year is 5%, but whether they'll achieve that remains to be seen. This number will be crucial, as many of Japan's fiscal and monetary policies are essentially on hold, waiting to see what happens. While Japan's real economy is struggling, the stock market is soaring, having risen nearly 50% from early 2023 to February 2024, reaching its highest point in nearly 30 years. Why is that? There are three main reasons. First, the weak yen makes Japanese stocks very cheap for US investors, and with the yen seemingly hitting a bottom around 150 to the dollar, many believe the BOJ will step in if the yen falls further. This has attracted a lot of foreign investment, which has been a key driver of the recent stock market rally. Second, Japan has benefited from the restructuring of global supply chains, especially in high-value sectors like semiconductors, which have seen their stocks double in a year. The weak yen also boosts exports, helping stocks in sectors like automobiles. However, many believe that these two factors, yen depreciation and supply chain restructuring, aren't the main drivers of Japan's stock market boom. The main reason is corporate reform. You might think that reform sounds like a vague and long-term process, but Japan's corporate reform this time is very concrete and has had an immediate impact. Japan's companies used to focus heavily on stability, not paying dividends, not laying off workers, and not caring much about shareholders. The BOJ's long-standing loose monetary policy spoiled these companies, leading to the creation of many zombie companies, departments, and processes, which in turn kept their stock valuations low. Many companies' price-to-book ratios were below 1, meaning their market value was less than their net assets. In other words, if a company liquidated and sold all its assets, shareholders would get more than the stock's market price. Investors saw little value in buying these stocks as they weren't making money or paying dividends. This led to Japan's stock market being labeled as a value trap. To address this, the Japanese government launched a reform plan in 2022, requiring companies with price-to-book ratios below 1 to make comprehensive changes. They needed to start paying dividends or buy back stocks to raise their valuations. If they didn't, they could face delisting in 2026. This forced companies to start thinking about how to make money and reward shareholders. From 2022, despite the challenges of the pandemic, Japanese companies increased stock buybacks and dividends, a trend likely to continue. An important figure driving Japan's stock market boom is Warren Buffett. When you hear about undervalued markets, the first person who comes to mind might be Buffett. 3 years ago, he invested about $6 billion in Japanese stocks, particularly in financial companies. Last year, at 93, Buffett even flew to Japan to urge these companies to pay dividends, saying it would be good for their development. He also increased his holdings in Japan's 5 major trading companies. This sent a clear signal to the market. While Buffett is known as the Oracle of Omaha, and no one can predict the future, if he's buying the market must be undervalued. Since Buffett's visit to Japan, the stock market has risen nearly 40%. While we can't say for sure how much of this is due to Buffett, the fact is that since his visit, Japanese stocks have surged. So for now, it looks like Buffett has won again. In summary, that's Japan's situation. That's why I say Japan is conflicted. If you listen again, you might have a different perspective. Japan has long sought inflation, but now that it has it, they don't like it. The BOJ is conflicted over whether to ease or tighten monetary policy. The yen is weak, capital is struggling, but exports are booming. Food prices are rising, but wages aren't. The real economy is weak, but the stock market keeps rising. In 2024, the World Bank estimates that Japan's GDP will grow by 0.9%. However, the market's focus may not be on this growth number. As you've probably gathered from everything I've said, 2024 will be a crucial year for Japan. The key question is whether Japan can escape deflation and whether it can smoothly transition its monetary policy to a more conventional state, one with normal interest rates, without the BOJ endlessly buying bonds and the government borrowing excessively but without causing any major crises. Just recently, several large Japanese banks raised their 10-year deposit rates from 0.002% to 0.2%, a 100-fold increase. If all goes well, the Japanese public should soon notice the difference, as they'll start earning some interest on their long-term savings. We will stop here for today and stay tuned for the next session where we will discuss India. Bye-bye.